It was only 2 days ago that a Wells Fargo analyst downgraded Amazon stock. He took his price target from 220 to 180, which Amazon today trades right around 180. So he's basically saying that Amazon doesn't have any upside. It is at its current fair value. That, of course, wasn't great for Amazon stock. The rest of the market traded up and Amazon stayed still. Well, only a day later, another analyst named Mark Mahaney upgraded Amazon stock. He upgraded it from 220 to 250. So we have a bit of disagreement here. Amazon is a divisive stock. There's analysts downgrading it and analysts upgrading it at the same time. Since we already went over the downgrade of Amazon stock, I think it would be good to look at the upgrade. Luckily for us, the analyst Mark Mahaney went on to CNBC to explain why he believes the stock is currently worth 250. So he sees some major upside in Amazon. It's his very top pick, and I'll be reacting to his appearance on CNBC today. Now, of course, we have some other news to get into. TikTok is once again being targeted by the US government. This time it's local governments. The District of Columbia's Attorney General went on to CNBC and explained that TikTok is nicotine for children. We'll be looking into why TikTok is so bad for kids, according to the government. We also have news that Costco is expanding into different concepts, like building Costco's underneath apartment complexes. As a longtime Costco shareholder, I'll share you my thoughts on this new adaptation and the ability for Costco to innovate. And then, of course, in a couple days, we have Tesla's RoboTaxi reveal coming up. We'll be looking over what to expect and how this is a make or break moment for Tesla. And then finally, as a little bit of a bonus, we have some TikToks to react to. This time it's TikToks of Google employees in a day of the life. We've seen these type of videos before. We also have someone visiting the offices of Salesforce. And we have, I think this is one of a young person that has like $100,000 that he's putting into meme coins. We'll be looking at that as well. I'll give you my reaction. So as always, we have a lot to get into in this episode. Let's go ahead and jump in. Now we start today off with the main story, which is Amazon, a stock that I've been following for years. It's one of the main holdings in my portfolio. If we look at the story fund here, Amazon is a $77,000 position, currently $20,000 in the green. It's been a great holding so far, and overall, I feel very bullish about Amazon. Both as a customer and as an investor, I use the product, I use the company. I constantly have boxes of Amazon products on my front porch. I'm always ordering stuff, my wife is as well. Our orders per year online seem to go up every single year, as it's just so convenient. Amazon gets things to your house so quickly. Not only that, I'm a customer of AWS, which is Amazon's web services, a major portion of the business. This website, Qualtrim, is hosted on AWS. So I use multiple parts of Amazon's business, whether it's Amazon Prime Video, watching movies, ordering products, or the web service, I use all of it. And it's grown a bit of a conviction to where I think this company is onto something. They play a bigger and bigger role in people's lives every single year. And I believe the intrinsic value of Amazon continues to grow over time as they make lifelong connections with customers. But regardless, a couple days ago, an analyst from Wells Fargo downgraded Amazon, asserting that the stock was no longer worth $220 per share. So he had a price target of $220, and then he downgraded it back to $180, which is where it trades right now. So this Wells Fargo analyst basically said that there's no more upside in Amazon, and he gave two primary reasons. One was that the cloud growth of Amazon's great, but it's not enough to overcome the challenges and the investments in the other businesses. The primary investment being Project Kuiper. Now, this caught my attention. When I see the analysts concerned about Project Kuiper, I wanted to look further into this. If you're not familiar, Project Kuiper is the copycat of Starlink. Now, I currently have a Starlink with the Starlink service because it allows me to go camping way out in a remote area in the woods next to a lake. A place I normally couldn't stay because there's no cell phone signal or internet access. But with Starlink, you can just aim it at the sky and suddenly you have high-speed internet and I can still manage my business. Starlink allows for a lot of freedoms to go places you couldn't go before and still have internet access. And it allows a lot of homes and remote areas to have access to the internet that they couldn't before. I think that Starlink and satellite internet is one of the most incredible innovations over the past decade. So I wasn't concerned about Amazon moving into this business. In fact, I was excited that there's some other competitor moving into this industry. But this analyst sees it differently, and he is concerned that the major investments going into Project Kuiper will lower the margins of Amazon, at least in the short term. A recent report from the Wall Street Journal has the same sentiment, saying that Amazon's earnings machine might take a breather. for how long is the $2 trillion question. They note the expected growth in Amazon's operating income, saying Amazon's operating income is expected to surge 69% this year and average 24% annual growth over the next 3 years, vastly outpacing the 11% revenue growth the company is expected to average over the same time. But this might be a challenge, given Amazon's expanding ambitions. Most notable amongst those is Project Kuiper, a low-orbit satellite network designed to provide broadband internet access to underserved parts of the globe. So Amazon is in the phase of just getting started with this. They've launched up a couple prototypes, and they're set to launch their actual satellites in 2025. They're going to launch like 80 of them. So they are way behind Starlink. They say that Kuiper is a program near and dear to the heart of Amazon's now spacefaring founder Jeff Bezos. It is also far from a sure thing, particularly given the lead of Elon Musk's Starlink service, which recently sent up its 7,000th satellite. So Amazon is launching up how many here? They're planning to launch 83, and Starlink has 7,000 in the air, and or low orbit. And that makes sense because whenever you hook up to Starlink, it literally takes within 10 minutes, and you're hooked up to a satellite with high-speed internet. Anywhere, as long as you can see the sky, it works flawlessly. Bezos used his last shareholder meeting as a chief executive in 2021 to drive that point home. He said, quote, "Can I stand here and tell you that our $10 billion investment in Kuiper will generate returns on invested capital? I can't. I believe it will, and we're working hard to ensure that that's the case." So even Jeff Bezos realizes how far behind they are. They're saying that there's no guarantee of return on capital here. Now, of course, a CEO should never say that an investment has a guaranteed ROI, but at least they can give a bit more confidence than this. This is a very open-ended, maybe it will, maybe it won't statement. And here we get to the crux of the problem. These satellites require a ton of upfront investment before turning a dime in profit. Several analysts are getting on the bandwagon that Wall Street's near-term estimates for Amazon aren't fully taking into account these upfront investments. So we have analysts like Brian Nowak from Morgan Stanley saying that it is a tactical risk. We have James Lee saying that there is a chance of downward revisions. And of course, we have the Wells Fargo analyst that we heard about 2 days ago, Ken Goreliski, saying, in our view, Kuiper is likely to put a cap on margin expansion in the near term. So here we see a group of analysts starting to converge against Amazon because the company's not going to have quite the earnings expansion and free cash flow growth that we once predicted. And this seems to be the ongoing case with Amazon. Isn't there always something they're doing that dampens their profits? A couple years ago, it was the expansion of their retail business, their logistics network. They doubled the size of it, major CapEx investments. That was supposed to be the major investment. Once that's over, then Amazon was supposed to have record free cash flow growth and profits. Well, after that, they had the artificial intelligence investment, major CapEx investments into AI, into their AWS system. But don't worry, we can wait until after that, and then they'll have the major free cash flow growth. But today, it seems like once again, Amazon is chasing down another rabbit hole. They're expanding into Project Kuiper. Once again, dampening or throwing cold water on that dream of Amazon having massive free cash flow growth and margin expansion. It seems like it's never going to be the case that Amazon will finally just focus on profits, grow record free cash flows, and investors can rejoice with their massive earnings they've made. Well, there's one investor that thinks that that will be the case, and this investor is not concerned about it. He's an analyst, and his name is Mark Mahaney, and he went on to CNBC to explain his $250 price prediction for Amazon. Now, he first starts off by giving an overview of Amazon and why this company is currently his top pick.
That's right. It's a number one pick in large cap, in mega cap. We think we're going to have ongoing margin expansion, both in the retail business and in the AWS business. That's for the company as a whole. I think free cash flow is continuing to improve, and we think we're going to see accelerating growth at their AWS segment and stable growth, kind of consistent, close to double-digit growth in their retail business. You put all that together, and we think there's a lot of valuation upside to the share. So yeah, we like Amazon right here, and Prime Day is just another feature of it. It's not a needle mover for the quarter per se, but it certainly helps, and it'll probably bring in more Prime members worldwide, which is always a win for Amazon.
I like that he's not focused on Prime Days being a key feature for Amazon being worth more. It's not a big part of his story of Amazon. He's focused on the free cash flow growth of the stock. Now, I know one of the main drivers of Amazon's free cash flow growth and the business overall is advertising. Amazon is becoming a bigger and bigger advertising company. I've said for over a year now that I believe Amazon has the best advertising product in the world with their direct ad listings under their searches. And Harry's asked about how much money Amazon really makes from advertising, and he breaks down the math.
Oh, that's a good question. They're doing about 50 billion now run rate in ad revenue, and they don't disclose what the margins are, but geez, it's got to be pretty high, Joe. I'm guessing they're doing almost 50% margins on that. If you look at what Google and Meta are able to do at that sort of scale, 50 billion a year in ad revenue. So that's 25 billion in up to 25 billion in operating income. It's a substantial percentage of their overall profits, a substantial percentage. The two biggest profit drivers here are AWS and advertising. And by the way, the good thing for Amazon and for Amazon shareholders is the fastest growing parts of the business are the highest margin. It's called a wonderful mix shift.
He's exactly right. Spot on again. Something that I've mentioned routinely before. All the best parts of Amazon's business, all the high margin portions of the business are the fastest growing. The dreaded low margin retail business, the first party retail business, is the slowest growing part of Amazon. So over time, Amazon's getting a better shift. The business is actually improving. The margins overall in the business is going higher, while Amazon maintains its extremely wide moat. So overall, I love seeing the developments that are going on with this business. And as he notes in this, Amazon is making around $20 billion per year in operating income just from advertising. And advertising will continue to grow. We've even heard just a couple days ago that Amazon is increasing the ad load on their Amazon Prime Video because nobody's canceling. And he also outlines the advances Amazon's making in their media business.
Yeah, Joe, I think that's been one of the biggest kind of, strategic pivots at the company. They've really leaned into being a media and entertainment empire is a strong word, but they certainly have a lot of professional content, licensed content, theatrical content. And then over the last 2 or 3 years, you've really also seen them lean into sports and where you get these massive audiences, major reach, major frequency, and you get high CPMs. And just beginning at this year, they started layering in ads into Amazon Prime Video. It was one of the biggest unmonetized ad platforms out there, potential ad platforms out there. We think that'll help with profitability. In fact, it's probably the single biggest driver of ramping margins, ramping up profitability at the company. The other one is on the retail side, they went through a major CapEx cycle in 2020 and 2021, and even in going into 2022. And now they've sort of been leveling that out. So you've got what's called rising capacity utilization, better usage of all this distribution centers that they may have overbuilt. But rising capital utilization, capacity utilization, there's another word for that. It's margin expansion. So you got these two kind of really nice tailwinds.
So he mentions an overall convergence of different reasons that Amazon's margins will likely expand. The additional ads on Amazon Prime. That is a further monetization mechanism for Amazon. The use of their unused capacity in their fulfillment centers. We know that Amazon, they overshot. They built too many fulfillment centers, and now they're finally filling that capacity. When you fill capacity with fulfillment centers or server farms, that is margin expansion. So we have all these different ways that Amazon can push margins up. But even so, he also goes on to address Project Kuiper and the investments in that.
Now, there's some headwinds here. They're starting to make a big investment in this satellite system called Kuiper. And but as long as they break that out and give us a sense of what those costs are and what they see as the revenue opportunity, I think the market will give them a little bit of the benefit of the doubt for that.
I once again agree. I don't see Project Kuiper as a wasted investment with no potential of return. I think there's a very good chance, proven by Starlink, that this can be a good business. Starlink has shown in and of themselves that this is a profitable business and it has massive demand. The internet is incredibly important. People can't get landline internet everywhere in the world. So Project Kuiper has massive potential. Starlink should not be the only single company that offers satellite internet. So even though it's not a wasted investment, Project Kuiper certainly is a near-term headwind. Now finally, he gets asked about his current price target on the company.
Yes, yeah, we did. We're up near 250 now. We're looking on 2026 and 30 times, 25 to 30 times free cash flow gets you there. And we think that kind of multiple for a kind of a key, brand, an enduring brand, Amazon's going to be around in 5, 10, 15, 20 years. a name like that can do premium growth for a substantial period of time, we think that that kind of multiple is well warranted.
So there we have his price target of 250 and his reasoning why. And I believe Mark Mahaney's reasoning for having that price target is much more compelling than what we've heard with other analysts downgrading the stock over short-term investments into Project Kuiper. It seems like some analysts can't see the forest from the trees. But Mark Mahaney looks at the overall picture. Amazon's growing in their AWS. They're growing in their ad revenue. They're fulfilling their fulfillment centers that they built a long time ago. Their margins should step up in lockstep. And this is a company that you can hold for 5 or 10 years and expect it to be around with a great degree of predictability. Amazon is currently at 185. If it went to 250, that would be a 35% increase in the stock price. Based off my share count right now, what I currently own of Amazon, I have $78,000 invested in this company. If the stock price increased by 35%, that would mean that it would grow to a $105,000 position. Now, I'm in a race against the S&P 500. I buy every company with the goal of outperforming the index. If Amazon raced up 35% over the next year or two, I have to imagine that would outperform the S&P 500. Now, of course, the S&P 500 could race up another 35%. There's always that possibility, but I think it's unlikely given the valuation of the S&P 500 overall. Many companies are at stretched valuations. And given my free cash flow forecast of Amazon and the resiliency of this business, I think that Amazon is not overstretched. In fact, I think the company is still undervalued. So I hold this one with the goal of outperforming the S&P 500 if Amazon gets anywhere close to 250. And the S&P 500 doesn't race up in lockstep with Amazon, this is going to propel the story fund further and further away of the S&P 500. Now that's the goal. We'll see if that happens. Now moving on, as we see more evidence over time of the damaging effect that TikTok has on kids, the company is becoming more and more of a target for lawsuits, especially this time from local governments. For example, we have here the District Attorney of DC explaining his lawsuit against TikTok. And some of the allegations here are pretty damning.
Well, thank you for having me. For young people, the TikTok platform is like digital nicotine. It's an addictive, dangerous product that lures young people into it, keeps their eyes glued to their screens for as long as possible, and then when young people are able to get off, lures them back. And that's all in furtherance of profits. The platform is designed to keep eyeballs on screens to drive ad revenue, and that's something that this lawsuit tries to tackle.
Now, obviously, the goal of every company is to make as much money as possible. I don't like the phrasing here where he's saying, you know, TikTok just wants to make a lot of money. Of course they do. Every company wants to make a lot of money. But I do like that he's outlining that some of the ways they're doing it is at the expense of the general public. Now let's go ahead and listen on.
We know that the impact on young people is severe in terms of mental health, in terms of loss of sleep and attention, rising levels of depression and anxiety. So this is a dangerous public health risk for our children across the country and certainly here in the District of Columbia. The lawsuit that I filed here in D.C., in addition, raises the fact that TikTok is engaged in an illegal, unlicensed money transmission business.
That is something that was new to me. TikTok has these different games where you can send money from one user to another as a gift. Now, I don't really understand it or the mechanics of it, but they heavily incentivize gifting other people money, and then it's in an ecosystem where you gift it back, and it becomes this money transfer scheme. And this is something that TikTok has monetized, that they've created into a big thing on the platform. And now it's moving a large sum of money. TikTok is actually managing a large amount of money that's being transferred from some users to others. And what he's bringing up here is that none of this is sanctioned or licensed. It's not regulated. TikTok is just doing this without any real regulation.
In real time, money is being transmitted between people, and that TikTok coin function, when coupled with TikTok Live, is lending itself to dangerous behavior, unregulated behavior that other money transmission companies like Venmo or PayPal have a requirement for safety and oversight that TikTok is evading.
So he lays the premise for this lawsuit, saying that TikTok is like nicotine. It's highly addicting and it's harmful, especially to children. They can't regulate how much time they've been on it. It causes them to lose sleep. It causes all these depression problems. And of course, it's overall a waste of time. Nobody goes away from TikTok after scrolling for 2 hours and says, that was a good use of my time. I feel much better now. Most of the time, it's regretful behavior from the user. Not only that, he says it's a money transfer scheme, a legal one that's without regulation, and of course they're benefiting from that. But ultimately, what he wants to change is very interesting here. The big thing he wants to change is the infinite scroll. He alleges that TikTok wants to keep users on the platform in a harmful way to the users and community, and in particular, the infinite scroll feature on social media. If he's successful in getting that feature changed on TikTok, that could have major implications for every infinite scroll feature on every social media website.
Most importantly, we want TikTok's dangerous functions to end. We want to make sure that young people are kept safer when they're using social media, that there are reasonable constraints on the time and on the ways in which young people are sucked into spending so much time on screen. We certainly think the money transmission business, as currently being operated, is illegal, needs to come into compliance with the requirements of DC law and consumer protection laws. And generally speaking, we want the exploitation and the lack of candor to children and their parents and to regulators to end. TikTok has not been straight with the public and with parents and with kids about how dangerous its product is, how dangerous it knows its product is, and the long-term impact of the addictive behaviors that its algorithm creates.
That's a long list of demands for TikTok: to end the money transfer scheme, to end the infinite scroll feature, to make it so that they can't buzz your phone with vibrations telling you to get back on the app every 5 minutes. If TikTok did that, they would lose engagement on the app. Of course, that would be worse for their shareholders and owners, so it's unlikely they're going to willingly do any of this. And that's the reason he's suing. Now, one thing I'll point out in this report and over again by these attorney generals is the damage that's happening to children by TikTok. They're talking about 10-year-olds, 9-year-olds, 13-year-olds using TikTok and being damaged because of it, having all these psychological issues because of TikTok. And even though I think the company has a big role to play there, they should lock down and have better protections, restrictions from young kids using their app. I think some responsibility has to fall on the parent here. And I don't give parenting advice. I know it's very difficult. I'm a parent of 3, so I understand the difficulty of it. But kids should not have TikTok. I think it's crazy that young kids, 9-year-olds, are able to have TikTok accounts. Lock your phones down. Lock that app store down. They have features to do that. I'll never allow TikTok on any of my kids' phones at any point. And I'll lead by example. I don't have it either. So if you have kids that are using TikTok, the best thing to do is just to get rid of it. Make their childhood better in the process. Now, again, the bigger picture here is if these lawsuits are successful against TikTok, removing things like the infinite scroll and limiting the amount of notifications, that could also be replicated across different social media companies like Instagram or Twitter. Instagram and Twitter both have infinite scroll. They don't stop the user from using Reels after a certain amount of time, even though that would probably be a healthy thing to do. So we'll get to see if these lawsuits are successful and what potential impacts they'll have on different companies. Now, moving on, we get to one of the most innovative companies in the world. We have companies like Tesla making RoboTaxis. We have NVIDIA making GPUs that people can't even dream of how powerful they are. And then we have perhaps the most innovative company, which is Costco. One of my long-term holdings here, Costco, the innovative long-term compounder, is once again at it again with their major innovations. And this time it's putting an apartment complex on top of the warehouse. This is thinking outside of the box, and I like what I see here. It won't be long before a select few Costco fans in Los Angeles will be able to live just a few flights above their favorite retailer. Thrive Living, a California-based developer, is converting a vacant lot in Baldwin Village neighborhood of a city into an amenity-rich apartment building complete with 800 rental units, a rooftop pool, gyms, and a basketball court. Sounds like they're doing this well. They're doing it the Costco way. Very high quality. Maybe not quite as cheap as Costco likes to keep things, but at least it's high quality. The most appealing amenity, however, might just be the Costco warehouse that is slated to take up the ground floor, complete with a pharmacy and optical services. How great would that be? You get to live on top of Costco. Anytime you want a hot dog and a drink for $1.50, all you do is you take the elevator down, right into Costco. So you can literally at any point in your life think, I'd like to go for a $1.50 hot dog and drink, and you go to the elevator, you're in the Costco, 5 minutes later, you got yourself your hot dog. You could get the chicken bake. You could even impulsively buy a 100-inch LED TV only 50 feet from your house. Where else would you be able to do that? Anytime you want, you can go down an elevator and walk right through a Costco. That'd be a pretty unique experience. Getting Costco on board is a significant win for Thrive, experts say. Everyone loves to be next to Costco and have Costco associated with their project. So this shows you a little bit of the reputation for Costco. Everyone wants to be part of it. Everyone wants to be next to it. They want to be as close proximity to Costco as possible. People talked about this as the Starbucks effect. Being next to a Starbucks was viewed as a good thing. That's no longer the case. Costco has taken the mantle. When Costco opens up central to a city, you know that's the place to be. And there's no closer place literally that you can be than living on top of Costco. The retailer's move could set a new precedent for the urban expansion strategies, giving Costco more flexibility to tap into densely populated areas and position itself closer to where shoppers live. So the big upside for Costco shareholders is if this concept is successful. If Costco says this turned out great, having an apartment complex on top of our warehouse, then that opens up a whole new world of opportunities. No longer are Costco's landlocked to open acres of field where they can buy a big plot of land, they can build their warehouse and have a huge parking lot. But now they'll be able to open up in densely populated areas where they have apartments above them and parking garages below them. The experience will be slightly different, but it will still be Costco. And this may be an opportunity for Costco to continue opening in all these important cities they want to be in. They mentioned that California in and of itself remains a massive growth path for Costco. The city that is home to the biggest percentage of their warehouses continues to be one of their biggest strengths and opportunities for a long runway of growth. The company has 140 warehouses throughout the state, and a little over a third of them are concentrated in Los Angeles. The Baldwin Village Costco will be the company's 53rd store in the city. So Costco is not yet saturated, even in California, even with 140 warehouses in the state. They're still having to cram them into different buildings and different concepts because people love Costco that much. So we're going to see how this turns out and what this concept does over the upcoming years. Now, moving on to a company that's also innovative, maybe slightly more innovative than Costco, which is Tesla. We know that in 2 days, Elon has his RoboTaxi day. There's going to be a big presentation, and hopefully this will be impressive to the shareholders because Tesla has gone nowhere for around 4 years now. Now, they note that even though Tesla has increased competition from companies like Waymo, it still commands a premium valuation at almost 90 times earnings estimates for the next 12 months, putting it among the high-flying tech companies like Palantir and Snowflake. Whether the stock will regain its previous highs or sink back to its lows is now up to Musk as he prepares to stand before investors at Tesla's RoboTaxi Day in Hollywood, California. Ostensibly, an event to highlight the self-driving technology that would allow the company to compete with the likes of Waymo and GM's Cruise. Musk needs to convince investors that Tesla remains the hotbed of innovation and still deserves to be thought of as a tech company like Apple, Amazon, or Alphabet. The outcome could determine whether Tesla regains its place among the Magnificent Seven or is relegated to fight it out with the dozens of automakers for EV market share. So they're building this up to be a pretty big event, saying that if Tesla doesn't nail this, if they don't show anything impressive, and it seems more and more like they're just another car company, the stock is not going to continue to do well. It should go down to a lower valuation, because even though Tesla has not gone far for the last 4 years in terms of stock price, it's still at a high valuation. The company's still trading with a lot of downside if things don't go well. Tesla stock has always been dependent on the future narrative of full self-driving and the RoboTaxi. Right now, Tesla is a company that has some level of full self-driving. It's impressive technology, but it's not quite enough to have a human enter into the backseat of the car and simply tell it to drive somewhere. It can't do that with enough reliability or safety. So Elon Musk has some convincing to do in this presentation. The biggest thing that they note here is the differences in strategy. Elon Musk is trying to make it so that cameras alone are enough to have a RoboTaxi or full self-driving. Just cameras. And that's different than the approach that Waymo and others have taken. So the stakes are very high for Tesla. The valuation remains high and the expectations high for this meeting. Now, it's going to be interesting what Elon Musk says, the timelines he gives, what he reveals. As always, this is going to be a massive spectacle, one of the biggest events for any stock in any industry. And of course, I'll be covering the event on this channel. Now, as tradition, every once in a while, at least before TikTok gets banned, I look at clips from TikTok of different financial people or people related to the companies I invest in to see what they're up to. And here we have 3 different clips I'll be reacting to. The first one is a Google employee. This one is an employee of Google in New York City saying, "Come work with me," in Google, New York City. So we get to see what they do for work, the tasks they're doing, the problems they're solving, how they're making the world better, and the challenges they're facing. Let's go ahead and take a look at this.
New York, Google, and Chelsea. I did not dress business casual at all. I even had my little kitten heels on. Badged in and went straight up to the 14th floor for some lunch. Started off with some shrimp salad, and it was delicious, and then some coffee, obviously. The vibe here was so much more social.
So we got our shrimp salad to start the day, and our nice coffee, our drink to start the day.
And so much more fun, and I kind of loved it.
And then we skipped the lunch. I swear I didn't fast forward here. We went from shrimp salad to drink, and then the next thing, without skipping any, is lunch. So apparently something must have happened before then. Maybe she edited out all the big challenges she solved. But it seems like we're on a food tour here more than a day in the work that we do.
Much more fun, and I kind of loved it. Got some Indian food and went outside, and then adventured the building a little bit, went into the game room. This Lego micro kitchen, amazing. Took a few apple cider.
And in between the drinks, so we went from lunch, we have pool. So there's a cool Google pool table there. That's fun. And then there's Legos with candy and different treats in them. And then we're back to drinks.
So yummy. And then a wheatgrass juice. Delicious. My intern friend from last summer. My feet are kind of killing me. So pretty.
That's the whole thing. We didn't skip any there. That was it. That is come work with me in Google in New York City. Now, of course, I mean, she must do something. Like, there's got to be some work she does that she must have edited out. But how does this represent the company well? When you share videos like this of the job that you work at, showing what food you eat, and then what food you eat, and then what games you play, and then how you relax at the top of the building with a great view, with no work whatsoever, with nothing showing that you've accomplished anything for the day, how does that represent your employer well? How does that represent you as an employee well? How does that do anyone any good in this situation? If I was Google, I would be frustrated with these employees. If I was a hardworking employee at Google, I would especially be frustrated with these coworkers that are creating this image of Google. And of course, every comment under this video are deservedly so criticisms of it. That we need more rate hikes, that Google can do more cost-cutting efforts at their company, that Google is a playground for adults, and so on and so forth. So you see the response these videos make, but yet somehow they keep happening. More and more employees at Google think that this is a good idea. Now we move on to Salesforce. This isn't an employee at Salesforce, but someone visiting the office. People are obsessed with the food that these really good hors d'oeuvres. Why is everybody obsessed with the food at these companies? It seems like the only reason they work there. But here we go. We continue on with it.
Some work done, and now for the taste test. They had this honeycomb mochi waffle, which was delicious, and this crispy fried potato with lox that I accidentally spilled on my laptop. Then we got some Italian ice and visited the game room, and then worked.
Now I will give her a defense. At least she's a food creator, so she's going around blogging about food specifically, which makes sense that most of the focus is on the food at Salesforce. But the first one with the Google employee is also focused almost entirely on the food, and I'm pretty sure her job at Google is not to be a food critic for the company. Now, finally, we get to the last TikTok here. This is one that I wanted to react to. It's very short, and it's a video of a kid that apparently has a $100,000 trading account, and it looks like he's in high school. So let's go ahead and take a look at this. So he has a 6-figure account in high school, and he's trading Hippo meme coins. The situation he's in is incredible. He has $100,000 in high school, and I like what he's doing here. At least he's trying to make more money with it, but I think he needs a little bit more direction. Imagine if instead of trading meme coins where there's a high likelihood of losing capital, he instead focused this $100,000 on buying compounders, companies that were growing free cash flow, that had positive future expected returns. That $100,000 could turn into millions in his 40s. He could be set with that amount of money he already has by the time he's 50, just by using it wisely and investing it properly. But hopefully he gets that guidance along the way. He may have to learn some hard lessons in the meantime. That's all for this episode. See you in the next one.